Well, we're online, so welcome to everybody to our CMAP or Mortgage Bootcamp or Equity Release Bootcamp, call it what you like. It's all about mortgages anyway. I'm Paul Archer. Stuff down below so you can subscribe and all those good things you want to. So welcome to our live stream. So I'm looking forward to the next 20 minutes or so, just updating you, keeping you informed, keeping you up to date with what's going on in this wonderful, wonderful mortgage world market that we find ourselves in. So what's been going on in the last week or so? Not an awful lot, but the brokers, of course, are saying it's the busiest month ever. You know, you go on LinkedIn and say, I've never been so busy in my life, you know. Great, but temper it down a bit, guys, because there are people actually furloughed still who are not actually going to go back to a job. There's a lot of stressed people in this country who are worried about their future, etc. So don't try and brag too much on LinkedIn. You know, let's just keep it a little bit low, shall we? Let's be a bit more modest than I think we are. So rant over on that one. But on the mortgage market, a lot going on really. The high loan to value marketplace is very competitive. In fact, there's not huge amounts going on up there. Lenders are very cautious at the moment and have therefore reduced their higher loan to value mortgages. Where they are offering them, the interest rates are going up slightly as well. And it's interesting to see one or two lenders now marketing their family type mortgages. There's one there called the Family Assist mortgage, which one of the building societies is doing, where it's clever really. Rather than a standard guarantor where they get a parent or somebody to act as guarantor for the first time buyer, they actually get the guarantor to supply a little bit more in the form of a surety. Now this is a deposit placed in the building society's coffers, which can't be withdrawn, of course, and that 20% deposit is allowed to enhance the lending that they'll do to the young first-time buyers. And what I like about the Family Assist mortgage is that they'll take a charge on the family's property. It's maybe a second charge possibly on the family's property, which doesn't enable therefore you to provide the cash. I think that's a really good system. I like that. I think that's really good because it means that the first-time buyer has to make payments and they don't actually get given any cash or any gift. But the lender is able to lend more with more security, like that one as well. Bit of a mini boom going on out there. I see properties going for sale and then sold the next day. So all is looking good for the mortgage market and the house market as well. But I've got to be a little bit careful because the autumn, of course, furloughs are coming to an end and we can see unemployment start to rise quite dramatically. So make sure that your mortgage business diversifies in areas that don't require the housing market to keep you sustained. Because with up to 3 million people unemployed, they're predicting. I don't know what the numbers are, but up to 3 million people unemployed. That's what we had in the early 80s when I came out of a sixth form college. That was terrible times. So in that situation, of course, a lot of people won't be moving house. So make sure you diversify your marketplace. Enough of that. Let's get on to our first topic for you of our live stream today. And the first topic really is taxation updates or syllabus updates. Call them what you like. So I'm going to call this one Taxation Update for you. Taxation Update for the new tax year. The Taxation Update for 2020-2021. Sounds very modern, doesn't it? And up to date. And that's what I want to take a look at with you. Now, as you can appreciate, those of you that are studying for your exams or are just keeping up to date with your CPD, you appreciate that the examining boards change their syllabus once a year. The CII are changing theirs on the 1st of September, so if you're doing the CF1 or CF6 RO1s, you get your new syllabus on the 1st of September, which means you'll be tested on the new tax year. And the new tax year, as I've written up there, is 2021. This started in April 2020, which is a few months ago, of course, and we'll finish next year. For those of you on the LIBF, they still haven't got around to changing their syllabus or giving an indication when they are. So you're still working on 2019-2020 tax year. Now the good news is, this is the good news, the tax changes are negligible this year, which is brilliant. Now, income tax, let's take a look at some of these tax changes, shall we, first of all. Income tax for the new tax year is pretty much the same as it was last tax year. So that's smiley faces all round. Now this means, of course, that there's no changes in tax rates. There's no changes in personal allowance rates. There's no changes in the high rate bands and all those good things, which is fantastic if you've just learned, if you like, the previous stuff. You get your tax sheet anyway in the exams, you don't need to worry about learning them. Scottish rates have changed slightly. I think the bands have changed slightly, so you'll need to check those up if you're working north of the border. They like to do things slightly differently, different tax rates, and this is the way it works. I totally get that. But in the exam, you'll be doing English and Welsh tax rate calculations and things like that, so you need to be aware of that one. The only slight change in income tax is the married couples allowance. Now, the married couples allowance, don't worry too much about it. This is for people born before 1935. So even my old dad doesn't even count for that. He was born in 1938. So these are people in their mid to late 80s. Still get a very small married couples allowance, which is quite useful, really, isn't it, if you think about it. Now, the rates there have changed slightly, so you need to check the tax sheets for that. So that's the first sort of major difference, if you like, but not a lot of change, which is great. So things that have changed for you. First of all, pension contributions. Let's put that in there for you, pensions. Now, pension contributions have a lot of tax information, a lot of numbers, and we've had one major change there. Everything remains the same, really. The annual allowance remains at £40,000, but the change that has occurred is the lifetime allowance. Now, the lifetime allowance, there you go, the lifetime allowance is, broadly speaking, the most you're allowed to put into your pension pot in any lifetime, effectively. Hence it's called your lifetime allowance. That's gone up by the CPI, I think it is. It's now 1,073,000. There you go. And £100. There you go. I had to look that one up, didn't I? That goes up each year by CPI. Hence that's gone up. But again, it's in the tax sheet, so you don't need to worry about remembering that. But broadly speaking, if you have a pension pot more than that, you'll end up paying tax. More tax than you plan to pay. So you don't want to do that, really. But most of us mere mortals wouldn't have anywhere near this sort of pension pot, would we, when it comes to it as well. Capital gains tax, CGT, let's squeeze that one over here, shall we? We're still there. Capital gains tax. The change there is the annual exemption has gone up, does every year. That's now £12,300, which I looked at this morning. That's the annual exemption. That means that once you've worked out all the capital gain, taken off all your deductions and things, all your allowances, you then got an annual exemption per person of £12,300, and that reduces your capital gains tax, which is pretty good news all round, isn't it? Inheritance tax is the same, so no changes on inheritance tax. That's all good news. Numbers there haven't changed at all. The main residence band, the new one that's come out, that's been solidified at 175 per person now, so no changes there whatsoever. Small change in ISAs. Let's put this one in red, shall we, so we can see this one differently. Small change in ISAs, individual savings accounts, of course, which allow you to invest money pretty much tax-free, which is pretty good all round, really, isn't it? Now, the limits here haven't changed. It's still 20 grand per ISA per person, and that's for all the different types of ISAs, except for GISAs. Now, the GISA, or the junior ISA, the limit there has gone up to a handsome £9,000, which is rather nice, isn't it? 9 grand. So if you've got little Bertie and you want to invest some money for little Bertie, you can put up to 9 grand a year in that, which is pretty good. Child trust funds, the CTFs that were phased out 2011, I think they were. If you've still got one, which is quite unusual if you do, then they also have a limit of £9,000. So that's just a small thing, isn't it? Corporation tax is the same. Rates have changed. The same there. VAT, the threshold's gone up, but the figures are still the same. National insurance still the same. The only other change you may come across in your studies is pensions credit. Now, pensions credit is the top up to your state pension. You know what it's like. So your only income you've got is a state pension. There's a lot of people in that situation, actually. The only income you've got is your state pension, and you don't get the full amount because you've not paid in it for all your life. Then you get pensions credit, which tops up your income to a specified figure, and if you're alone, it tops it up to £173.75. If you're a couple, it tops it up to, let's just squeeze that one in the bottom there for you, to £265, there you go, and 20 pence. But these are all on the tax sheet, you don't need to remember that. But what basically happens there is that they top your income up to that figure. But it also opens up the floodgates to everything else, like your council tax reduction as well. So those of you in the equity release later life marketplace, you need to be aware of pensions credit and the impact it has as well. So broadly speaking then, not a lot of changes, which is fantastic, don't you think? So not a lot of things to think about. Syllabus themselves have hardly changed at all. So don't get too worried about a new tax year coming in or a new syllabus that's going to test you, because if you've got an old book, you're probably okay with that anyway, so I won't worry too much about it. So that's good news for those people that are doing their exams very shortly, isn't it? As soon as the LIBF decide to change their syllabus, we'll do the same with our materials and things, but again, not a lot of changes, which is good. We'll keep you posted in these live streams. I hope that's been useful. Bye. Ha! Okay, did you like that one, did you? So, good. Good. Don't forget you get your tax sheets, you get all the information in the tax sheets. You don't need to faff around trying to remember all these things, but you need to be able to apply them, of course, which goes without saying, doesn't it? You have to apply this information, it's the whole point behind it. There you go. The old Her Majesty's Customs and Revenue are a bit short of cash at the moment. They've been doshing out money left, right and centre. And borrowing huge amounts of money, so I think the next 5-10 years we're going to have an awful lot of higher tax rates to pay for all this money that they're spending. People don't appreciate that. It's going to be paid back. Okay, they inflationise the national debt, but national debts have got to be paid back. Did after the Second World War, so look forward to higher taxes in the next few years. So look towards ways in which you can reduce your taxes. Last subject for you today, I want to talk about a topic that we've talked about many times before, and that's property ownership, joint tenants and tenants in common. Now you would have talked about this in your CMAPs and things, so this one's primarily for equity release people, because I want to give it a context of that one. So we're talking here, on the subject I want to talk about for a few minutes is joint tenants versus tenants in common. Joint tenants, there you go, versus tenants in common. There you go, that's out of a title, isn't it? There you go. Now, if you are in Scotland, and many of our viewers are, and rightly so, they call it different things up there. They call that joint property, and this one's known as common property, which actually is probably a better name for it, actually, if truth be told. So you've got joint property, and over there you've got common property, and that's a better description, really. Now we're talking here about the basis of ownership of a property. So if you buy a property, I'm not talking about mortgages here, they're different altogether. If you buy a property, so let's put our little Des Res up here for you, our little desirable residence with a little chimney there for you as well. There's your property, wonky roof. And when you buy a property, you buy it on your own, of course, that's sole ownership. But if you buy it with 2 or more people, that's known as joint ownership. So let's just put our 2 people in here for you. There you go, a little bit of people there for you, just because I can draw my lovely little pictures. So you've got your typical couple there buying a property. And when you buy a property jointly, you need to decide how you're going to own it. And it's how you own the equity in the property. That's the key thing here. It's the value of the property, how that's been owned. And there's 2 ways of doing it, of course. The first way of doing it is what's known as joint property, or joint tenancy as we called it before. Now joint tenancy, let's put this one over here. Joint tenancy is very straightforward, really. This is where both parties, or whatever, all own 100% of the property. That's the difference here. So this party owns 100% and this party owns 100%. There's no split, there's nothing. They both automatically own 100% of the property. Now on death, which is usually the typical situation, one person dies, of course, the other person automatically owns the property. There's no transfer of assets or money going into an estate and probate dividing all up. None of that palaver. The person automatically owns that property. There's no inheritance tax issues either, because they're deemed to automatically own it. So that's pretty straightforward, isn't it, at the end of the day? The debt also is divided accordingly. The mortgage debt is also effectively joint tenancy. Both parties own 100% of the debt, so the debt's going to transfer across as well. So remember, of course, life assurance and protection. Now, when it comes to equity release, if you're releasing equity under a lifetime mortgage and you're doing it for a couple who own a property, they like to have joint tenancy. It's what they like. It's how they work, and we'll explain that to you in a second why that is the case. The second way of doing it, of course, is what we call tenants in common. There you go. Tenants in common, or common property in Scotland. Very different altogether. Tenants in common, is where you own a particular percentage preordained. In other words, when you decide to buy the property, you own a particular percentage of the property. So it could be that this couple decide to have 60% for her, and he owns 40%. Now that's preordained, and then it goes to the land registry. The land registry will register that. You'll have that jotted down in the proprietorship register, and that will show the ownership as well. So not a lot of people are aware of that, but the land registry will show a restriction for that one as well. And obviously what happens there on death, if one dies, that share of their property goes into their estate, and that's the whole point behind it. So if, for example, this lady died, let's put a little sort of, there's your death symbol. If that person dies, her ownership of the equity of the property will then go into her estate in the normal manner, and that then gets inherited by somebody else through a will or the law of intestacy, whatever it is. It doesn't go to the other person unless, of course, that person is named in the will, and they will receive it, but it will take a while to get there. So that's the issue there, of course. That's on death. On sale, it's the same concept. So if they were to sell this property, pay off any mortgage, the equity that's left over will be shared according to their percentage shares. So it's often used for unmarried couples, often used for siblings who buy together, buying a property for the first time. I did in 1989. I bought a property with my brother and a friend. There's three of us. We had tenants in common. We owned a particular percentage each of that property because we went our separate ways. In fact, one of the guys died, but we'll talk about that another time. We went our separate ways, and of course we owned a specific amount of equity. And that's the way people like to roll when it comes to owning a property and they're not married, which is typically what tends to happen. Now you can change these. Again, not a lot of people are aware of that. You can change it. You can change it from joint tenancy to tenants in common by filling in a standard land registry form and getting the land registry to change things. You don't really even need a lawyer to do that. You can do it yourself if you want to, if you're willing to talk to the land registry. And of course, vice versa. You can go from tenants in common to joint tenancy. But there might be some issues around stamp duty, so you need to take a look at the ownership change and how equity is moving around, so be careful of that. Now, not a lot of people change this arrangement halfway through. Some may well do. They may well, for example, be unmarried and they buy a property together, 50-50, tenants in common, they might get married and turn it into joint tenancy. That's perfectly acceptable to do that, but most people don't. However, you will if you are looking in the equity release market. And let's just say, for example, let's just get my rub out here. Let's take out the joint tenancy situation, and we'll put the tenants in common one in there for you, so you can see that one working quite well. These people applying for a lifetime mortgage, a joint lifetime mortgage roll-up, where the mortgage there's no payments until both people have died, and then of course they have the mortgage paid off. In that situation, lenders are very wary about having a tenants in common arrangement. They don't like it, it's messy. Because think about it, one person dies, then the share of their property goes into their estate and might go off to grandchildren. Lenders don't like that because they want the mortgage to carry on until both people have died or gone into a care home. So what they often require you as a mortgage broker to do, they like you to check it out early. And if you find that your clients are under a tenants in common arrangement, then you'll need to get that switched over pretty quickly to a joint tenancy, and therefore the lender will accept it as adequate security. If you don't do it beforehand, you can do it as part of the conveyance. You can get the property changed before the mortgage is granted, when we're actually being conveyed as well. So you do need to be aware of that and why lenders operate that situation. It makes sense if you think about it. Equity release mortgages are very, very different to normal mortgages. You're relying on the property as your security. You're not looking at payments from the person. And you want that mortgage paid off once the people have died or both gone into care home, and both of them you want that to happen to, not just the one, of course. So that's something to think about with joint tenants and tenants in common. Lovely little topic there for you. Hope that's cleared things up. Bye. Great stuff. Hope you enjoyed that one. We're going to wrap up now. It's coming up to 20 past 12. So hope you enjoyed the latest live stream. We won't be live streaming next Monday because it's a bank holiday here in the UK, and it's probably going to be raining because it always rains on August bank holiday, doesn't it? I think there's a song, wasn't it? It always does. So that's just the way it goes. We'll probably do one Tuesday for you, or maybe the following week. We'll see how things pan out. Other than that, have a fantastic rest of the summer. Well, I heard on Countryfile last night, on BBC Countryfile, the weatherman said that summer has finished and welcome the autumn. He said it's not even the end of August and summer has finished. You can see why people like to go abroad for the holidays, can't you? Because it's never warm in this country. The summer is appalling. But most of us are stuck here in the UK enjoying our breaks. But such is life. There's people worse off than us. Come on, let's think about it. People are moaning about lockdown and the issues caused. There's people in this world an awful lot worse off than us, if you think about it. There's people waking up this morning who haven't got enough food to feed their kids, you know, and they're starving and hungry and they're in a war-torn environment. So think about that sometimes. But summer's not so bad. We'll see you in a couple of weeks' time. Bye.